I think the best way that I can describe this is I see it as institutional rot. And the more that we're left to our own devices, that amount of institutional decay becomes more and more obvious. Our governments don't work the way that they should. Our state assemblies are basically co-opted by special interests. The federal institutions we rely on to make rules are not that great. Enormous amounts of money get wasted every day. And as more and more people become aware of these things, the trend is just so bad,
Hey guys, welcome back to the channel. Today we have Chamath on the All In podcast, giving us the news in stocks, economy, and the financial markets. People might be saying that the Fed will yield by early 2023, and there is a clear expectation that rate increases will have to occur. The Fed must take rates above the central 5% threshold when the CPI is higher than 5% to break adequate demand and the economy can be restarted. The government needs to remove all surplus money from the system to discover what the equilibrium demand is so everything can return to normal. Chamath believes the period of faster, cheaper, better is finished. This means better national security, but higher prices. Chamath believes we can still have perpetual growth, even though it will mean higher input cost, inflation, and interest rates. All indicators point to the massive similarities between the current recessionary climate and the stock market crash of 2008. Let's get into the interview with Chamath as he lets us know what to expect in the next few months. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
But to say that, the US economy is automated in a way where, they can sit in front of some dashboard and, see in real time what the true on the ground data is not really accurate, unfortunately. Maybe there's a Manhattan Project type, effort to do that at some point for the United States, but it's not now. I'll give you a bit of bad news and a bit of good news. And this is just me kind of, again, looking at the mosaic and kind of judging where we are today. The bad news is I think that it's going to be a really tough, sticky time for the US consumer, probably over the next 18 months. And so I tend to think that, through the course of this year and through 2023, and possibly even a little bit of 24, it's going to be a grind. Unemployment will go back up. Inflation will be sticky. Real earnings will shrink. Consumption will ebb. And earnings will not be that great. But the silver lining is I think that we are starting a bottoming process for the equity markets. And I think that by the end of this year or the early part of next year, most of that will be done. And the reason is that, the equity markets, I think, do a reasonable job of one, looking at the bond market, and then two, looking 6 to 9 months into the future and pricing in that future today. And so by the end of this year, beginning of next year, I think that we will have kind of bottomed and we'll start to build a base. The thing to remind us, though, is that, let's just say a stock goes down 50%. Even if it rallies 50% from there, it's still 25% off from where it was.
Yeah, people don't understand that.
And people don't understand
how hard it is to climb back up the mountain.
So I would just think, tell people that, I think that David is right. I think that we're going to feel this for a while. This inflation, as I've said for a long time, is going to be sticky and persistent. I think you're going to see Fed funds at or breaching 5%. But I think that in terms of, risk assets will bottom out by the end of this year, beginning of next year.
The increasing prices of goods and services, along with stagnant wages, slower business growth, and a surge in layoffs, a recession is a certainty at this point. Some believe we're currently in a stock market crash as we speak because of all the panic selling that's going on. The amount of global market value that has been wiped out in just the last 5 months is astounding, and now the banking infrastructure is being threatened.
I mean, Larry Summers had some good tweets this week. The weird thing is Larry Summers seems to be like almost trying to make the case and make certain points because he's not being listened to. I mean, it's so ironic and sad to watch because he's such a thoughtful economist and has such a great point of view and experience to leverage here. And clearly, he was banging the drums last year and no one was listening, and then he got public about it, and now he's more repeatedly public about things. The point that he's made, which I think plays into the political cycle question, which is where the tension arises, is in order to resolve ultimately the inflation problem, you're going to have to see a significant increment in unemployment. And so when you raise interest rates, generally purchasing goes down, demand goes down, revenue goes down, layoffs happen. Some businesses go bankrupt, et cetera. So then there's this trickle in the economy of less people being employed. And when that happens, it ultimately drives a political response, which is, hey, we're losing our jobs. People start asking their representatives, do something about this in Congress. And then these programs and these things get passed, which themselves are inflationary. And that's why it's very hard to predict ultimately when and how this all gets resolved, because we seem to have an administration that is enacting and embracing inflationary policies to support what they consider to be economic growth and improved employment conditions in this country. And the unfortunate effect of many of those policies is inflation. And then it forces this difficult central bank decision-making cycle. And so there's a tension right now that doesn't seem to have a clear path to resolution. That is why it's very hard to have a clear prediction here. We also have a very significant question overhanging all of these markets related to the price of energy, which is a key input to so many industries and drives cost, as well as food, and also the military conflict in Eastern Europe. And and then there's in the financial markets this big overhang question on what's going to happen with various countries that may default on their debt, as well as China's real estate bubble bursting. So I made this point, I think, a few episodes ago, but there's no easy answer that I can just say deterministically, here's my prediction of what's going to happen. As Chamath uses the term, I think it's a great term. There's this mosaic of things that are under consideration right now, and there's a tension between them all. And that's what makes it difficult. I'm sorry I didn't really answer the question, but that's kind of how I think about it.
There's a lot of geopolitical risk.
Yeah.
I mean, we're kind of, ignoring what happened this week where Putin basically is putting nukes back on the table. Now, I'm not saying that's likely to happen, but I don't know how this market gets a lot better with the risk of World War III hanging over our heads. I mean, who wants to enter the market with that on the table? And
by the way, the nukes, just to be clear, you can hear certain military commanders speaking publicly about this, but in the Russian military playbooks, there is specifically defined actions that can lead to tactical nuclear weapon use in the field. There's no direct indication that these things are going to be used right away, but as Sachs says, there's like this weird turning up the volume happening on, hey, maybe we're getting closer to a point where if Putin is having tactical failure in this conflict, there's more weaponry he can use that has greater impact. And unfortunately, there are these tactical nukes in his arsenal. And, a guy that maybe has a certain psychology that has, as our friends have said, his back against the wall, he's not a person who in his career or in his history has ever acquiesced to defeat.
Alex Karp was on CNBC. He was really, really sharp and concise about this, which is that, in the West, when leaders fail in their objectives, they just get elected out and somebody else takes their place.
Yeah.
But for somebody like Putin, there is nobody to take his place because it's a very zero-sum situation. And so his actions will, as a result, also be zero-sum. And I think folks...
He's never acquiesced in his life. And
yeah, we've never really we don't understand well what zero-sum decision-making looks like when it comes to stuff like this.
He needs the golden bridge, right? You need to give him the golden bridge out.
But I'll just say two things. One is that I think it's been made pretty clear that both India and China will not stand beside Russia if they do something like this. And I think that is important because they still are the two biggest purchasers of Russian oil. And so I think that matters a lot because you're talking about a lot of revenue that would go away.
Even though the market may be operating on fear right now, the coming months will be a clear indicator of what we can expect from the stock, crypto, and capital markets. The average consumer will be the one affected most by this recessionary climate, and something else to keep an eye on is the financial corrections happening in the credit and housing markets. The interest rates on loans are rapidly increasing, and Chamath believes we may actually be seeing a bubble there as well. What do you think about the market conditions right now, and how do you think the average consumer will be affected? Comment down below. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.